In this video, I will show you why I chose dividend investing and how much more cash flow in the form of dividends I generate with my portfolio, with examples from my own portfolio, including an overview of my complete portfolio, the cash flow that comes into my account in the form of dividends every month, and the capital appreciation I get as icing on the cake. We have a popular video like this in which Ben Felix tells us why dividends are irrelevant, but we also have a video like this from Joseph Carlson, telling us why he chose dividend growth investing. So who the heck should we believe, and who am I, a guy with a dividend portfolio below 20k, to tell you what strategy to pick? That is why instead I will show you today with my own portfolio why I chose dividend growth investing and how that's working out for me so far. So you can decide for yourself. There are countless discussions whether index investing, growth investing or dividend growth investing offers better returns. And purely based on total return, you can cherry pick to make one strategy look like it is better performing than the other one by selecting a certain time frame or a certain basket of stocks. But you know what? None of that matters if you are not able to keep holding your stocks over that period of time, or as the cool kids from the crypto space say it nowadays, it is easy to look at a past return chart with a 10% annual return of the last 20 years and think, I'll just do that over the next 20 years and I'll be good. Because the last time I checked, I'm not a robot, and neither are you probably. A chart like that doesn't tell you how it really feels to lose 30, 40 or sometimes 50% of your total portfolio in a few months. And that brings me to my first point why I invest in dividend stocks. The psychology behind it. A lot of people will tell you, just like Ben Felix, that dividends are irrelevant because they are paid from the profits of a company, and otherwise those profits would be reinvested in a business for even bigger profits, giving you more price appreciation of your stocks. But without receiving dividends, you have to endure those downturns that will always come with nothing to show for it, besides virtual gains that you can only cash out if you sell. If you do receive dividends and you have been wise to not chase ultra high dividends that were likely to be cut anyway, in most cases you will still receive your dividends, no matter if the stock price is down 50% or not. We all remember March of 2020, right? First a 30% crash and then a big upswing. Though that crash was short, at that time if you followed the news or YouTube, it looked like the world was ending. I'm sure plenty of people sold, but my dividends just kept coming in as usual. And looking at the first and second quarter of 2020, it looks like nothing was going on. They just kept increasing. So even if my portfolio was, this time very shortly burning a hole in my gains, the cash was still coming in. And not even that, my dividend companies were still raising their dividends. That is like a pay raise I didn't have to do anything for. In the third quarter there was a dip in dividends due to Tensure Factory Outlets cutting its dividend temporarily. But it was still above the level of 2019, and after that they just kept increasing again. Fast forward to today, in the month of June. This month I was paid by 9 companies. Enrich paid me for the first time for an amount of $5.89. This will be higher in the next quarter again. Johnson & Johnson paid me $2.70, an increase of almost 5%. Thank you, Johnson & Johnson. 3M paid me a nice 7.55 in dividends. The utility Northwestern Corp paid me 3.69 in June. Another dividend increase this month is Pepsi, which sent 1.84 my way, a 6% increase compared to last quarter. T. Rowe Price paid me 5.51 in June, and some exciting news came out about T. Rowe Price. More on that later. The third company that paid me more than last quarter is Qualcomm, which paid 3.4. Again, a 5% increase. Visa paid me for the first time a full 27 cents. And VF Corp paid me $2.5 as well. All of this for a total of 33.43. This is a nice 39% increase year over year. And look at that nice increase quarter over quarter. How about some more graphs? Just because it's fun. My dividend year over year growth looks like this. We are now halfway through 2021, and as you can see, it is way over half of the amount I received in 2020 already. More dividends? If I want to get a boost in dividends, I can just look at this graph to see which one currently has the highest dividend yield. By the way, these cool graphs, I've not made them myself. I am a Patreon member of Joseph Carlson. Another reason people often discard dividend investing is the price appreciation, or the slow growth of dividend companies. Yes, I don't have companies that went up 5,000%. I realize that is the norm nowadays, so sorry to disappoint you there. But I see capital appreciation as icing on the cake, the dividend cake. I receive cash flow in the form of dividends every month, and almost every quarter and every year that stream of dividends is growing. Just look at this graph and you can see what I mean. And this is only with I think a very minimal monthly contribution of about $200 per month. On top of that, the dividends I receive are again used to make new investments. But as you can see here, my portfolio has not really been stagnant. My portfolio still has 18 companies that are weighted in my portfolio has 18 companies that are weighted like this in my portfolio. Omega Healthcare Investors and CVS are still the biggest holdings. In fact, I actually added to CVS in the last half a year, because I think they are still on sale. In terms of unrealized gains, excluding dividends, in terms of money, Williams-Sonoma leads the pack. T. Rowe Price is in second place and Omega Healthcare is in third. So right now, the portfolio value is at $16,777 with a cost of almost $12,000. So far, my portfolio has spit out $1,217 in dividends. I've gained almost 41% excluding dividends and 51% including dividends. And that gap will start to widen as my portion of dividends coming in are getting bigger. But the S&P 500 has gained about 83% during that same time. So no, I'm not beating the S&P 500 at this time. So then the obvious question is, why on earth would you not just invest in the S&P 500 instead? And the answer is easy. My focus is on cash flow, not necessarily capital appreciation. The dividend yield is at 1.37 for the S&P 500. My current yield is 3.4% and my yield on cost is almost 4.8%. So on a 10k investment, that is $137 in dividends versus $480 in dividends per year with my portfolio. And there's another reason why I invest in dividend stocks instead of an index or growth stocks. I don't like to slaughter the golden goose that lays my eggs. Let me explain. The typical strategy with index or growth investing is to withdraw based on the 4% rule, meaning you sell 4% of your stocks each year to get the needed cash flow in the retirement or withdrawal phase. Meaning your amount of shares will go down because you sell part of them. As for me, I will get cash flow without selling those shares. That is why I prefer dividend investing. So what is next? July is going to be a very exciting month, with the special $3 a share dividend of T. Rowe Price coming in. Now you know why I chose dividend investing? Check out this video on the right to find out how I actually build up my dividend portfolio to over 16k now. Until next time, bye bye.